Sports company. Sports company is a large manufacturing company specializing in the manufacture of a wide range of sports clothing and equipment. The company has two divisions, clothing and equipment. Each division operates with little intervention from overhead office, and divisional managers have autonomy to make decisions about long-term investments. Sports company measures the performance of its division using return on investment calculated using controllable profits and average divisional net assets. So, sports company measures its performance of its division using ROI and calculated using controllable profit upon divisional net assets. We already know this. The target ROI for each of the division is 18%. Okay. Let's read what the question is asking first. The question is asking us to calculate the return on investment for each of two divisions. So it is very simple, but for that we need to read the question because the question might have relevant information about what divisions are actually controlling or not controlling. Last year, an investment which was expected to meet the target of ROI was rejected by one of the divisional managers because it would have reduced the division's overall ROI. Consequently, sports company is considering the introduction of a new performance measure, residual income. Okay, in order to discourage this dysfunctional behavior in the future, like ROI, this would be calculated using controllable profit and average divisional net assets. Okay, so information for division C and division E is given, and opening and okay, opening balances of controllable net assets and closing balance is also given. Okay, what are the notes? Including in the fixed costs are depreciation cost of 1,65,000 and 4,64 division C and E respectively. 30% of the division depreciation cost in each division relates to assets controlled but not owned by head office. 30% of the depreciation cost in each division relates to assets controlled but not owned by head office. Division E invested 2 million in plant and machinery at the beginning of the year, which is included in the net asset figures above, and uses the reducing balance method to depreciate assets. Division C, which uses the straight line methods, made no significant additions to non-current assets. It is the policy of both divisions to charge a full year's depreciation in the year of acquisition. Head office recharges all of its cost to the two divisions. These have been included in the fixed cost and amount to 6,20,000 for division C and 7 lakh for division E. Sports company has a cost of capital of 12%. Part A. First part. Calculate the return on investment for each of the two divisions of sports company. Let me mention you, these are Kaplan kit questions. Even if I have cropped by mistake any of the question or I miss anything, you can actually refer to the Kaplan kit. So the return on investment, there are two divisions, division C and another division is division E. So how do we calculate this? You need to calculate return on investments which are controllable profits upon controllable assets. So we need to calculate the controllable profit, but it's already given in the question. As per the information which was given above, we feel that this sale revenue and every variable cost were controlled by the division itself. So I can say that the entire profit of the division is controlled by the division. Okay, I do not need to adjust or exclude something. So I am saying my controllable profit is 1455 and another is 3950. 3950. And what are my controllable assets? My controllable assets are, we have been given this as 13,000 and 9,000 opening and closing. So I'll have to average them. Okay. Whenever opening and closing balances are given, in case of ratios also, which is covered in this performance management portion, in FR also we have done ratios, and in PM also we are doing ratios. So in that, what I have noticed is whenever opening and closing balances are given, we take out the average balances, and whenever only the closing balance is given, we only consider the closing balance. So the average controllable assets of division C would be 13,000 plus 9,000 divided by 2,000, that is 11,000. And for division E, it's 24,000 plus 30,000 divided by 2, it's 27,000. Now I can calculate the ROI, but I've missed something, I guess. In the profit itself only, I've missed something. Okay. So, okay. Included in the fixed cost are depreciation cost of 1,65,000 and 4,60,000 for division C and E. 30% of the depreciation cost in each division relates to assets controlled but not owned by the head office. These are okay. So I literally have missed this information. Another point was given was head office recharges all of its costs to the two division. Recharges all of its costs to the two division. These have, and as I mentioned earlier that there are no adjustments required to be done, that statement was incorrect. I think we need to calculate the controllable profit by adjusting this information which is given in point 1, 2 and 3. So I'll calculate that. So included in the fixed assets are depreciation cost of 1,65,000 and 4,60,000. 30%, 1,65,000 and 30% of it is this much. Okay. And this is written for CNE, and 30% of the depreciation cost in each division relates to assets controlled but not owned by the head office. Relates to assets controlled but not owned. So what we will do, it was written that these are maybe the 30% of the depreciation which was there, which is given over here. These have been what? Included in the fixed cost. Where are the fixed cost? Where fixed cost is 945. So in that, this depreciation cost was included, and this depreciation cost which was included in the fixed cost of division, it is mentioned that 30% of the depreciation cost in each of the division relates to assets controlled but not owned by the head office. So what needs to be done? This was actually controllable by the division and not the head office, because these assets were not owned by the head office. Okay, so what shall we do? See, this can be a bit confusing. First of all, we need to decide whether this 30% of the division cost pertains to division or the head office. So I can say that this pertains to the head office only. Now, if it pertains to head office, should it have been included in this 945 and 1420 balance? No, this should have not been included in that. If it had not been included in that, the profit would have been higher, the profit would have been increased. So that means we need to increase our profit. So what we will do, we will add back. Okay, so we will add back. So this is something which was not related to our division, this 30%. So what I've done is I've taken the depreciation which has been given by the in the question and calculated 30% of it, and I can say that this is of head office and not the branch. If it's of the head office, it does not need to be included in the depreciation, right? So it does not needs to be included by the in the depreciation, and hence what adjustment will I do with my profit? I will increase, because over here, because of including this 30% portion, my fixed cost for the division is a bit higher, and hence I'm getting low amount of net profit. But if I'll exclude that depreciation portion which pertains to head office, my net profit will increase. So I will add. So what was the net profit? Net profit given to us was 14553950, and I will add. So these figures are in thousand. So I will add back the depreciation of head office, which is 49.5 and 138. What else information is given? Head office recharges all of its cost to the two divisions. Head office recharges all of its cost to the two divisions. These have been included in the fixed cost, and the amount was 6,20,000 and 7 lakh. So the head office recharges all of its cost to two divisions. These have been included in the fixed cost. So the fixed cost also includes 6,20,000 and 7 lakh, and this cost was also for head office only. It was not controllable by division, and therefore I need to exclude this from the fixed cost given in the question. If I will exclude this fixed cost given over here in the question, my profit will increase. So I will have to increase my net profit by the fixed cost of HO by 620 and 700. So my net profit, which is adjusted and controllable. So I had first stated that no, we do not need to do any adjustment. That statement was incorrect. Let me just calculate 1455 plus 49.5 plus 620. It is giving me a profit of 2124.5, and this is 3950,138 plus 700. This is giving me a profit of 4788. So now I have controllable profit, which I calculated as 2124.5 and 4788. Now what should be my ROI? What should be my ROI? ROI should be 2124.5 upon 11,000, 4788 upon 27,000. So this is my ROI. I think my first part has been calculated. Now it is saying discuss the performance of two divisions for the year, including the main reason why their ROI results differ from each other. Explain the impact of difference in the ROI could have an on the behavior of the manager of worst performing division. So this is I think in every question they are asking if there is ROI, the bonus is linked with the ROI, and it is asking us that how it is impacting the manager's performance, or how it will motivate or demotivate the manager. Some sort of questions are coming every time if it's ROI, because the bonuses might be linked on the ROI as well. So let's read this out. This is all discursive. So I'll read it from the Kaplan kit itself. While division C has exceeded the target ROI. What was the target ROI? The target ROI was 18%, right? So we have calculated this, and the ROI over here for division C is 19.31, and for division E it's 17.7. So we can clearly see that division C has overachieved. So it has overachieved or exceeded the target ROI. Division E has not. If controllable profit in relation to revenue is considered, division C's margin, if controllable profit in relation to revenue is considered, the margin is 56% as compared to division E's margin 57%. So division E actually performed slightly better. Now what it's saying is, if you look at the question, the net profit which is earned over here is what? So this is not net profit, this is net profit. And what about the operating profit? Operating profit is 2400, right? If I look at the, see, there can be net income ratio as well, right? Net which is based on your net income upon sales revenue, right? So if I calculate that, I can clearly see that 1455 upon 3800, it's okay. No. So we can do that. We can do by the net income approach as well. But since I have calculate the controllable, we are talking about the divisions actually. So if I go by this net profit, it is not the actual net profit, right? We have already adjusted it, so we cannot consider that. What we need to consider is the net adjusted profit which we have calculated over here. So I can clearly see that 2124.5 divided by the revenue which is given in the question 3800, this is 55.9, so 56%. So for division C it's 56%. What have I calculated? So this is my net profit or net margin ratio. Okay, so net profit or net margin ratio, this is 56 for this division C, and let's see what's the same ratio for division E. 4788 divided by 8400, it is giving me 57%, exact 57%. That means we can say that division E's performance is actually higher than division C's performance. One fact is this. However, division E has larger net assets. Now division E, if I look at the division E has larger net assets, and because of which the ROI is less. And over here we can see that my net assets over here in division C are comparatively low. So the ROI definitely was higher for division C. But is this a true picture? This can demotivate the manager. Definitely it will demotivate the manager. Manager will say, I have performed and my division is working better than division C. The manager of division E can definitely say that I am working better than division C, because my division is has has given much more net profit margin ratio. So it is much higher for my division. I have my division performance is better, but then why my bonus will be less? Right, the bonus is dependent on the ROI. So this way the division E's manager would feel demotivated. Since division E appears to be much higher, much larger division, and is involved in sports equipment manufacturing, then it could be expected to have more assets. Division E's assets have gone up partly because it made a substantial addition to plant and machinery. This means that as well as increasing the average assets figure, the addition will have been depreciated during the year, thus leading to lower profits. This may potentially have led to a large impact on the profit since Division E uses the reducing method of depreciation, meaning more depreciation is being charged. Okay. So, based on the result, the manager of division C will get a bonus rather than, and the manager of division E will not. This will have a negative impact on the motivation level of the manager of division E and may discourage them from making future investments unless a change in the performance measure is used or adopted. Okay. Now let's jump on to part B. We have done this. Now part B says calculate the residual income. Residual income for each of the two divisions, and briefly comment on the results of this performance. How do we calculate? We have the controllable profits calculated in part 1. So controllable profits was 2124.5 and 4788 minus what is the cost of capital given? 12%. Cost of capital. So cost of capital will be applied on what? We have calculated the average assets controlled by division C and E. That was 11,000. So 11,000 20%. No, 12%. Sorry, 11,000. 12%. It will give me 1320. This I will have to reduce, and 27,000 of 12%. This will give me 3240, and I will get residual income as 2124.5 minus 1320, that is 804.5, and 4788 minus 4788 minus 3240, that is 1548. So this is the residual income. Now let's read further. From the residual income results, it can clearly be seen that both divisions have performed well with healthy residual income figures between 0.8 and 1.55 million. Okay. The cost of capital of sports company is significantly lower than the target return on investment, which the company seeks. Okay, making the residual income figure show a more positive position. So what it's trying to say is that your cost of capital as compared to the return on investment is really low. So if your cost will be low, the return will be high. You will get a positive return. So if you get the positive return, this itself only means that you are, first of all, your capital employed, whatever capital you have employed are perfect. Whatever capital has been employed in the business is perfect. Apart from that, one thing is this, and whatever the cost of capital rate is, that also is appropriate because it's giving you positive residual income. Had it given the negative residual income, that means the cost of capital is too high. So I would say that the cost of capital is perfectly okay if we need to if we need to generate a return on investment which we had calculated over here. So the investments done are completely fine. Now the second part of part B is explain the advantages and disadvantages of residual income. I think we had discussed this in previous question as well, but let's read again. The use of residual income should encourage the manager to make new investment if the investment adds to residual income figure. A new investment can add to residual income figure but reduce the ROI. Definitely, see, if my ROI is if my residual income is positive, that means I'm saying my cost of capital is perfect. The cost which is being incurred on the capital is perfect. That means I can employ much more. I can make a higher capital expenditure, so it can encourage me, right? So which can and this capital employ if I will invest much more in the capital employed, then it can give me better returns, better profit can be generated by the division, so my net profit margin can be much more higher. So instead, ROI will lead to decisions which residual income will lead to decisions which are in the best interest of the company as a whole, right? The example which I had given right now was beneficial because for the division, for the company as a whole, it might be less for the less beneficial for the manager because the manager's bonus is dependent on the ROI. And if you will invest more in the if you will make more capital expenditure, the capital employed would be more and your denominator would be more, and your ROI will be reduced. And if the ROI will be reduced, then your manager would get less bonus. But if you think about the company as a whole, making capital expenditure is a win-win situation because it will generate profit, and you can generate a better ROCE or a net profit margin as well. So the residual income is a dysfunctional decision making because it uses whole company's cost of capital. So positive residual income projects for the company would also be accepted by the divisions. In this case, we can see that yes, both are positive, so you accepted. Now, did you notice that this is giving a less residual income as compared to this? Seeing this, the division manager can say, yeah, my firm, my division has the capacity and we can employ more and we can incur more cost. So, a non-financial manager might not make such decision, right? So it can lead to dysfunctional decisions as well because it only gives you the cost of capital of the entire company. So positive projects for the company would be accepted by the divisions. Since the imputed interest charge is deducted from the profit when measuring the performance of the division, managers are made more aware of the cost of the assets under their control. This is a benefit as it discourages wasteful spending. But why will somebody invest just like that if, like, you have this positive residual income? Why will the operational manager of the division has the assets under his or her control? So this decision needs to be taken by the divisional manager whether to make some investment or not. Now this can reduce his profit, one, because reduce his bonus. Why? Because if he will make more capital expenditure, the ROI would reduce and the bonus would get reduced. So if the bonus would get reduced, the manager would avoid making unnecessary capital expenditures because the manager knows That okay, if I make unnecessary capital expenditures, then my bonus will get reduced. So I do not need to make an unnecessary capital expenditure. This will avoid wasteful spendings. Alternative cost of capital can be applied to the divisions and investment to account for division for different levels of risk, and this can allow more informed decision making. Disadvantage, these were the advantages, like it controls the wasteful expenditure being done by the managers. Second is like it can lead to improvement of the overall performance of the company. This was one. Now what are the advantages? Let me see how much okay, so you this question is for 4 marks. We can include two advantages and two disadvantages. So two advantages have been given. Two disadvantages can be that residual income does not facilitate the comparison between the divisions, since residual income is driven by the size of the divisions and their investments. So this can clearly be seen in sports company, where the residual income of E is almost twice that of division C. Yes, which can be related to division E being a much larger division. So, residual income is also based on accounting measure of profit and capital employed, which may be subject to manipulation. So, very first disadvantage of residual income, I could say that it does not facilitate a very good way of comparison, right? Over here, I was saying that my ROI is less, and over here, I can say the residual income is high. Now, how can I judge whether I need to make any investment, or this is, this is a profitable division or not? Because ultimately division E is benefiting to the company, as it is giving me a higher net profit margin, but at the same time the ROI is less, the return on investment is less. So what decision do I need to make, whether I need to make further capital expenditure or not? I am confused over here. So it does not gives me a proper base for making some decision. Plus this is all based on accounting information, your profits and capital employed. This can be easily manipulated by the managers, because they have access to the financials. They sit with the auditors, and they sit with the management information systems head. They have the access to the enterprise resource planning tools, so they can definitely manipulate.